Welcome to the deep dive. Today, we're really digging into the mind of Charlie Munger, the longtime partner of Warren Buffett at Berkshire Hathaway.
That's right.
Our guide is Tren Griffin's book, Charlie Munger, The Complete Investor. We've got excerpts covering his key ideas and, interestingly, a question about how this all applies, beyond just making money.
hmm
So our mission, really, is to pull out the most useful, actionable bits of wisdom, not just for investing, but, well, for thinking better about everything in life. Okay, let's get right into it.
Yeah, and it's fascinating. Munger's whole setup, he's based in Omaha, Nebraska, far from Wall Street, right? And his core idea is surprisingly simple almost. I observe what works and what doesn't and why.
It sounds so practical, down to earth.
Exactly. It's about looking at the world, well, practically.
And his path wasn't exactly typical Wall Street either, was it? I mean, studied math, served as a meteorologist, then Harvard Law, apparently without an undergrad degree.
Yeah, quite the journey.
Built a successful law career, then met Buffett while living out in California, actually, and bam, full-time investing.
Yeah.
And the results, pretty stunning.
Oh, definitely.
That partnership, from 62 to 75, it returned nearly 20% a year. Compare that to the Dow Jones, which was under 5% then.
Yep.
Big difference.
Huge difference.
What also stands out is his lifestyle. The book mentions, no Ferraris, no massive mansion. It suggests his focus was somewhere else, deeper perhaps.
I think that's a great point. His diverse background probably gave him a much wider lens. And being grounded like that, it suggests he was after something more fundamental than just wealth, like understanding how things actually work.
Exactly. Now, for you listening, we get it, time's valuable. You want the insights, the knowledge, but without getting bogged down, right? So this deep dive is designed to be that shortcut, a clear path to grasping Munger's core thinking. Let's start with how he approached, well, thinking itself, decision-making.
Right. And one of the first things that jumps out is his belief in process. A book says he's a great believer in solving hard problems by using a checklist.
Checklists. Sounds simple, but powerful.
Very. The idea is that good thinking isn't just, raw genius. It's about having systems, frameworks to cut through complexity, reduce errors.
And writing things down is part of that system, isn't it? There's that Buffett quote, if you cannot write it down, you have not thought it through.
Spot on. It forces clarity, rigor.
Where?
And this flows right into his big ideas.
No.
Worldly wisdom and the lattice work of mental models. His argument is basically, you can't really understand anything just by memorizing facts in isolation.
Like collecting trivia.
Yeah, exactly. The facts need context. They need to, as he says, hang together on a lattice work of theory. You need to see the patterns, not just the data points.
So it's about connecting the dots, building a bigger picture.
Precisely. And crucially, he stresses using multiple models from the big disciplines. He warns against being the man with a hammer.
Right, where everything looks like a nail because that's your only tool, your one area of expertise.
Exactly. You apply your narrow specialty to every problem, even when it doesn't fit. Munger argued it's better to be worldly wise, with several models, getting things approximately right, than precisely wrong with just one narrow view.
So this really goes way beyond finance then. He's saying read history, psychology, science, maybe even literature,
Yeah.
and that makes you a better investor.
Absolutely. And a better thinker, generally. He saw the danger in narrow expertise. Someone brilliant in one field might make terrible decisions outside it because they lack the mental toolkit. His approach is about mastering the best that other people have ever figured out. Leverage collective wisdom. Don't reinvent the wheel.
Makes perfect sense. So how do you actually use this lattice work day to day?
Well, one technique he really likes is inversion. Instead of just thinking, how do I succeed, you flip it.
You ask, how could I fail?
Exactly. Or, what should I avoid doing? It's like in algebra, sometimes solving for the opposite helps. Looking for the ways things go wrong helps you build that worldly wisdom, helps you spot pitfalls.
Interesting. So asking, what are the dumbest investment mistakes, might be as useful as asking, what makes a great investment?
Precisely. And this whole lattice work approach, using models from different fields, acts as a kind of double check, as Munger called it.
Ah,
You use ideas from psychology, from engineering, from wherever, to look at an investment problem from multiple angles. The goal isn't necessarily to be brilliant, but more consistently not be stupid.
Yeah.
You'll still make mistakes, but hopefully fewer big ones.
right. Okay, let's pivot a bit to his specific investing principles. The book mentions his view on mispricing in the market. That quote about needing someone else to be a damn fool.
Yeah, that's classic Munger. Very realistic, isn't it? He understood that big opportunities, those serious mispricings, don't happen every day. They happen because someone else makes a significant error.
So you can't force it.
Right. So Graham value investors, in his view, need to be patient. They wait for those opportunities, those fat pitches, to show up. They're not trying to predict next week's market moves.
Which leads us to that whole active versus passive investing debate. What's the take in the book?
Well, he acknowledges something kind of paradoxical. He says even dumb money, people who admit they don't know how to pick stocks and just buy index funds.
The passive approach.
Yeah, they can actually end up doing better than a lot of the pros who are actively trading. Just admitting your limits can be a winning move.
But the book also says even index investors need something more, right? They're not totally off the hook.
No, exactly. Just buying an index fund doesn't mean you won't mess it up. You still need to develop a trained response to your own psychology.
The behavioral biases.
Right. The urge to panic sell when the market drops or buy in when it's already high. That doesn't go away just because you own an index fund. Understanding Munger helps manage those urges.
Okay. And when he did look at individual companies, what was he looking for?
He had a clear focus. Businesses with a significant track record, generating high, sustained, and consistent returns. Real history.
Not just hype or projections.
Exactly. If figuring out the value meant predicting hash flows years out based on superfast tech changes, that often went into his too hard pile. He didn't need to have an opinion on every single company.
Stay within your circle of competence. We'll come back to that. The book also contrasts intrinsic value with speculation, using Keynes' definition.
Yeah, that's a really key distinction. Munger, like Graham, focused on the intrinsic value of a business, its real underlying worth, which he said does not depend on its share price.
So separate from market mood swings.
Right. Speculation, like Keynes described it, is about forecasting the psychology of the market, trying to guess what other people are going to do. Munger avoided that whole Keynesian beauty contest.
Got it. Business fundamentals first. And then the absolute bedrock principle for Graham value investors, the margin of safety.
Oh, absolutely. Munger called it the single principle that should rise above all others. Graham defined it simply as buying something for a price significantly below its indicated or appraised value, its intrinsic value.
It's like getting a discount.
A big one, hopefully. It's that cushion against being wrong in your valuation. Because you will be wrong sometimes. The book really stresses the patience needed to wait for opportunities with that adequate margin.
And underpinning all of this, the most critical quality seems to be rationality.
Yes. Munger hammers this home. Rationality is the most important quality. It's the best antidote, he says, to making those psychological and emotional errors. And it's not easy. It's something he worked hard at.
Which is a perfect segue into that whole section on the psychology of human misjudgment. He identified all these tendencies that lead us astray.
Yeah, it's a fascinating list. These deep-seated ways our brains work can systematically trip us up, especially when dealing with risk and money.
Let's run through a few examples. The book mentions the reward and punishment super-response tendency.
Basic stuff, really. You get what you reward for. But think about misaligned incentives, like a broker pushing a product because they get a big commission, not because it's best for you. That can be really damaging.
Makes sense. Then there's the liking-loving tendency.
We tend to overlook flaws in people or things we like. We even bend the facts to fit. The book warns, don't trust someone with your money just because you like them, and actively seek out people who disagree with you to get a clearer picture.
And the flip side, the disliking-hating tendency.
Yeah. Munger thought, ethically, you should just avoid doing business with people you really dislike. But also be careful not to let irrational prejudice like disliking someone just because of who they associate with cloud your business judgment.
What about doubt avoidance? That sounds counterintuitive.
Our brains don't like uncertainty. They want quick answers. So we tend to jump in conclusions to resolve doubt. But in investing, that can be dangerous. Think about people ignoring the red flags around Madoff. Avoiding doubt felt easier.
And inconsistency avoidance, sticking to our guns.
Totally. We hate to admit we were wrong, especially if we've said something publicly. We cling to old ideas. So, Munger's advice, be careful what you say out loud. It makes it harder to change your mind later.
Even curiosity can be a double-edged sword, right? The curiosity tendency.
Yeah, curiosity drives learning, which is great, but too much scattered curiosity. It can lead to a lack of focus, spreading yourself too thin. Need balance.
Okay. What about the Kantian fairness tendency?
We're wired to expect fairness. But life isn't always fair, is it? Sometimes rules that benefit the group might not seem fair to one individual in a specific case.
And envy. The envy-jealousy tendency.
Well, Munger saw that as incredibly destructive, often subconscious, rooted in feeling like there's not enough to go around. He flat out said, nothing good comes from envy. It just pushes people to take stupid risks trying to keep up.
The reciprocation tendency, that feeling of needing to return a favor.
Exactly. It's automatic. Someone does something small for you, you feel obliged. Compliance pros know how to use this to get bigger concessions later.
And influence from mere association, like in advertising?
Yep. Link a product with happy, attractive people often enough, and some of that positive feeling just rubs off subconsciously. Misleading, often.
Pain-avoiding psychological denial. Sticking your head in the sand.
We hate bad news. We deny reality when it's painful. Again, think Madoff investors ignoring warning signs because the returns felt so good.
The excessive self-regard tendency, thinking we're better than we are.
Yeah. Most people think they're above average drivers, right?
Right.
We overestimate our skills. That's why staying in your circle of competence is so important. Be realistic about what you actually know.
Related to that is the over-optimism tendency.
We generally expect things to turn out better than they probably will. Leads to underestimating risks.
Deprival superreaction, why losing hurts more than winning feels good.
Exactly. Losses loom larger than corresponding gains. This makes us do irrational things, like holding on to losers way too long, hoping to get back to even.
Social proof? Following the herd?
Big one. Especially when things are uncertain, we look at what others are doing. That's how you get bubbles and crashes. Everyone runs together.
Contrast misreaction, judging things relatively.
Yeah. A $10 price jump seems small after a $100 jump, even if $10 is still a lot. Our perception is easily skewed by what came just before.
Stress influence, making bad calls under pressure.
Definitely. Too much stress, lousy decisions. High-pressure sales tactics play on this. Keeping a cool head is vital.
Availability misweighing, overvaluing vivid or recent information.
Right. That big lottery winner gets tons of press, so we overestimate our own tiny chances because the idea of winning is so available in our minds.
Use it or lose it skills fade without practice.
Just like muscles. Financial knowledge, investment skill, you need to keep working at it, keep learning, or it degrades.
Drug misinfluence seems pretty straightforward.
Yeah, Munger was blunt. Avoid drugs, excessive alcohol, they ruin judgment, ruin lives. Simple.
Authority misinfluence, blindly following the leader.
People tend to obey authority figures, even when they're clearly wrong. Think classic psychology experiments. Need to question authority.
The twaddle tendency sounds funny.
It means wasting time on nonsense, basically. Pointless talk, unnecessary complexity that adds no value. Bureaucracies are good at generating twaddle.
Reason respecting. We like reasons, even bad ones.
Yeah, people are more likely to comply if you give any reason, even a dumb one like because I need to make copies. We're wired to respond to the structure of a reason.
And finally, the big one, Lollapalooza tendency.
That's when several of these biases gang up together. They interact, reinforce each other, and create these extreme outcomes, way bigger than any single bias acting alone. Think about the 2007-08 financial crisis, a perfect storm of psychological errors.
Wow. So just knowing about these tendencies is the first step to fighting them, right? Both in investing and, well, everywhere else.
Absolutely. Awareness is key. Okay, so moving on, the book talks about the right stuff, the characteristics Munger saw in successful investors.
And it sounds like it's less about pure IQ and more about temperament, character.
That's a huge part of it, yes. Cultivated traits.
Patience comes up again. A lot.
Definitely. Munger stressed. Success means being very patient, but aggressive when it's time. Wait. Then act decisively. He liked Buffett's line about the market transferring money from the active to the patient. Don't just do something, stand there until it's time to act.
And that takes discipline, right? To just sit and wait.
Immense discipline. The book connects that disciplined inactivity with success in value investing, resisting the urge to constantly tinker.
But when the moment does come, you need to be calm, courageous, and decisive.
Yeah, you can't be timid, Munger said, and that applies to all of life. Being a contrarian, buying when others are fearful, takes real courage, like him buying bank stocks in the thick of the 2009 crisis. Big, decisive move.
Lifelong learning is another must-have.
Non-negotiable. Be a learning machine, constantly reading, constantly learning from mistakes yours and others. Reading widely is essential.
Trustworthiness is also in there, surprisingly perhaps.
Not surprising to Munger. He saw trust as the bedrock of good relationships, which are vital in business and investing. Long-term partnerships depend on it.
And confidence, but a specific kind, not arrogance, and being non-ideological.
Right. Develop correct confidence, grounded in knowledge, but always be aware you could be wrong. Humility. And avoid heavy ideology, political, economic, whatever. It filters reality, prevents clear thinking.
A long-term view seems embedded in everything.
Totally. Our system will work better in the long term. Understand compounding. Although he acknowledged that first chunk of capital, that first $100,000, is the hardest part.
Focus and preparation also make the list.
Crucial. Cut out the noise, concentrate, and do the homework. Think of Buffett spending weeks, months learning everything about an industry before investing. That's the level of prep required.
And finally, being collegial, having people to talk to.
Yeah, he believed in having trusted people, colleagues. You could bounce ideas off. Helps organize your own thoughts, challenges your blind spots. Even geniuses need sounding boards.
Okay, so that's the ideal investor. Now, what about the right stuff in a business? What makes a company attractive in Munger's eyes?
You see the same themes applied, really. Rationality, long-term thinking, but now directed at the company itself.
First up is rational capital allocation.
Yeah, avoid the institutional imperative. That's the tendency for companies to just grow for growth's sake, imitate competitors mindlessly, resist necessary changes. Good companies put capital where it earns the best return for shareholders.
And compensation systems need to be aligned.
Definitely. Management's pay should track long-term shareholder value. Munger disliked massive pay for mediocre performance, or hiring consultants just to justify high salaries. Needs to be fair and aligned.
Low bureaucracy is a plus.
Big time. Too much red tape, too many layers, it slows things down, kills motivation. He preferred organizations built on a seamless web of deserved trust, lean and effective.
And he liked businesses that pass the idiot manager test.
Yeah. Basically, is the business so strong, its competitive advantages so powerful, that even an average manager can't mess it up too badly? He preferred that kind of fundamental strength.
But great management is still valuable, right?
Oh, for sure. While the business economics might be primary, truly exceptional managers are rare and can add enormous value. He'd bet on business momentum first, but wouldn't ignore a truly brilliant leader.
Which leads us naturally to moats, economic moats. Sustainable competitive advantages.
Right, the core idea. A business earning high returns on capital significantly above its cost of capital for a long time must have some kind of protection, a moat defending his castle of profits.
And the book lays out 5 main types. First is supply-side economies of scale and scope.
Yeah, scale means lower costs per unit as you produce more. Think Intel making chips or Walmart's giant distribution system. Scope means sharing resources across different products efficiently. Chain stores get purchasing power from scale, too.
Okay. Second is demand-side economies of scale network effects.
This is where the product gets more valuable as more people use it. Think Craigslist, eBay, Facebook. Each new user adds value for all the others. American Express benefits from this, too. More cardholders attract more merchants, and vice versa.
Third type of moat, brand.
A strong brand means customers trust it, maybe love it, and are willing to pay more. See's Candies is a classic Munger example, deep regional loyalty. Coke, Disney, huge global brands. But brands can be damaged too. The real test Munger liked. Could a competitor replicate it, even with billions to spend?
Fourth, patents, trade secrets, intellectual property.
Legal protection. Like patents on a drug or a chemical process like Lubrizol, or even something like the unique store design of See's, keeps competitors from directly copying key aspects of the business.
And the fifth moat isn't one single thing.
Right. It's the cumulative impact of many factors working together. Berkshire itself is an example. Tax efficiency, low overhead, great reputation, permanent capital from insurance float, loyal shareholders. It all combines into something very hard to replicate. The whole is greater than the sum of the parts.
But these moats aren't forever, are they?
Definitely not. Capitalism's creative destruction is always at work. Competitors chip away, new technologies emerge, moats erode. Think Kodak, a dominant moat that just vanished. The lifespan of a moat varies hugely.
So understanding moats involves a few key skills.
Yeah, the book mentions 3. Being able to create moats, if you're running a business, being able to identify existing moats as an investor, and spotting potential future moats in startups. Munger and Buffett mostly focused on buying businesses with existing durable moats.
Okay. Then the book quickly lists the 7 variables in the Graham value investing system, kind of a summary checklist.
Yeah, key things to consider within that value investing framework.
First, circle of competence. We touched on this.
Right. Invest where you have a real edge, genuine knowledge, Don't confuse just being familiar with something with actually understanding it deeply. Use inversion. But I understand. That helps define the circle.
Second, focus investing.
Know a few things really well, rather than a little bit about a lot. Concentrate your bets on your best ideas, the ones you think are truly mispriced.
Third, patience. Again.
Can't stress it enough. Wait for that fat pitch. Investing isn't about constant action. It's about waiting for the rare, great opportunity. Like pari-mutuel betting, find the odds that are out of whack with reality.
Fourth, low downside, big upside. Optionality.
Look for asymmetric bets. Situations where if you're right, you win big, but if you're wrong, you don't lose much. Avoid coin flips, or situations with big potential losses and only small potential gains.
Fifth, quality of the business. An evolution from early Graham.
Yeah, Munger and Buffett increasingly focused on buying wonderful businesses at fair prices, not just mediocre businesses at cheap prices.
Yeah.
Aim to get more quality than you pay for. The big money often comes from owning high-quality businesses for a long time.
Sixth, quality of management. Important, but maybe secondary.
Often secondary to the business economics. Remember the idiot manager test? But still important. Great management in a great business is ideal.
And seventh, price. Valuation is key.
Absolutely crucial. What's the intrinsic value? Hard to know precisely, but you need an estimate. And remember, a great company bought at too high a price can be a terrible investment. And a beaten-down stock isn't automatically cheap or safe.
Okay, that covers a huge amount of ground from the book, so let's tackle that final question. What's one principle from the book that applies beyond investing?
That's a great question because so much of it does apply broadly. But if I had to pick one core principle, it really has to be that idea of worldly wisdom through the lattice work of mental models.
The multidisciplinary approach.
Exactly. The fundamental idea that you need to draw on insights from many different fields, psychology, history, science, whatever, to truly understand complex situations and make better decisions. That applies everywhere. Career choices, relationships, understanding politics, managing a team.
Right. Avoiding that narrow, single-discipline view.
Yeah. It's about having a richer, more robust toolkit for thinking about any problem. That seems like the most universally applicable takeaway.
I'd agree. And maybe closely tied to that is the focus on rationality and understanding the psychological biases. I mean, those affect every decision we make, don't they?
Absolutely. Knowing your own mental traps, striving for objectivity, that's just a life skill, full stop.
Right.
Helps you navigate everything more effectively, not just your portfolio.
Okay, so let's quickly recap the key takeaways. Munger really emphasizes that multidisciplinary thinking, the lattice work, worldly wisdom, the absolute need for rationality and understanding our psychological pitfalls. For investing specifically, it's value principles, margin of safety, focus on businesses you understand, look for quality. And that concept of economic moats, finding companies with durable advantages.
Spot on. Which leads to a final thought for you, listening. How could you actively cultivate your own lattice work of mental models? Think about it. How might deliberately learning concepts from different fields, maybe fields totally unrelated to your job, fundamentally change how you approach problems, how you make decisions in your own life? What's one new discipline you could explore to just broaden your understanding of how the world works? Something to chew on.